Wow, so this week, the biggest financial regulator in Canada, the ones who write the rules that the big banks have to follow, made a major change to one of their requirements in order to prevent the destabilization of the Canadian financial system, hinting that banks and Canadian individuals should be preparing for a rather tough 2023. And this change isn't going to just impact the big banks, it'll actually have an impact on many different groups of Canadians, especially including people who are just struggling to make ends meet amidst the higher cost of living, as well as anybody who has any exposure to the Canadian real estate market or is looking at buying a house in the next number of years. So why don't we talk about what this change is, the thing that they're afraid of that prompted this change, as well as how it could impact you directly. So let's dive right in, and of course, if you haven't already subscribed, make sure to subscribe to the channel to keep on getting Canadian-focused financial updates just like this one. We're talking today about OSFI or OSFI, the Office of the Superintendent of Financial Institutions. It's a long name, but essentially these are just the guys that make the rules that banks and financial institutions have to pay attention to and have to follow. This includes small banks, as well as pension funds they regulate, as well as the big Canadian banks that you probably know about: BMO, Scotiabank, TD, Royal Bank of Canada, RBC, as well as CIBC, and that's especially important for what we're going to talk about today. They're really focused on making sure that the Canadian financial system is stable and does not experience what they call structural risk, or in a worst case scenario, having a situation where these banks could fail and it could result in sort of a cascading effect on the Canadian economy. And you're probably familiar with one of these stability rules. It's called the minimum qualifying rate for uninsured mortgages, or more colloquially known as the mortgage stress test. We've talked about it a bunch on the channel. They said, hey, we're worried that people are qualifying for mortgages at too low of a rate, and if interest rates were to go up, they wouldn't be able to afford it. So they said, actually, you gotta make sure you pass the stress test. In order to get a mortgage down here, you have to qualify for a mortgage up here. We've talked a lot about how now people are passing the point where they've been stress tested, but that's a story for another day. But just this week, they changed a different rule that the big banks have to follow, and this is in the wake of, well, Canadians getting more and more into debt. We saw an article this week saying that Canadian consumer debt has hit 2.36 trillion, with mortgages, credit card spending, both of those things rising. Canadians are more in debt, and it has OSFI a little bit worried. They're saying, okay, well, we're in so much debt now that there could be structural risks going forward, especially as the Bank of Canada is raising interest rates. So they've changed this rule, and it's called the domestic stability buffer. It sounds super complex, but it really isn't. Let me explain. Now, bankers, just like politicians and just like central bankers, have this tendency to make names for things way more complex than they need to be, and it makes things look overwhelming so that people don't take a closer look at it, but all of this is easy to understand, even though it might seem overwhelming at first. Now, you might already be familiar with the idea that banks don't actually have to keep on hand all of the money that they're holding for their customers. They can lend out more money than they actually have. This is called fractional reserve banking, but there is a requirement that these banks do hold a certain percentage of the amount of total deposits that they have on their books, and this is called their capital reserve requirements, essentially cash that must be kept on hand, and this is a percentage relative to the amount of money they actually have in the bank. There are a bunch of different things that make up the amount of this capital reserve requirement for each bank, and one of those things that contributes to it is the domestic stability buffer. This is what we're talking about today and what OSFI is changing. This is a tool that OSFI uses to say, okay, if we hit a worst case scenario, you have to make sure you have a certain amount of cash on hand at your institution, and they can move this number up and down, and that will either increase or decrease how much money the big banks have to have on hand at all times. And this number applies to all of the assets that the banks have on hand. To oversimplify this is essentially loans that the bank has given out, right? They have assets that are mortgages, they're paying them interest, the banks are getting paid interest by the people who have mortgages, same with credit cards or lines of credit, car loans. These are all different assets that the banks have. So if the domestic stability buffer is applied to these assets, the banks either have to keep more or less on hand relative to the amount of assets they have. And the way that they get their number for the amount of assets a bank has is a little bit interesting. They say that it's risk weighted. So essentially for the loans that they've given out that are secured against something, like maybe a mortgage against a house, they might say that's only kind of risky or not so risky, but they might have other loans like credit cards to people who have low credit scores. They might say that that's very risky that these people will actually not pay off the loan. And they take these riskier assets into more consideration when they're coming up with this risk-weighted asset number, and they'll take the not risky ones less into consideration, and ultimately they'll get to the total amount of money that is considered their risk-weighted asset, and that's what the domestic stability buffer is applied to. It's all going to make sense here. We're going to clarify. And I promise once we get through this, you're going to understand how this change that's being made is going to impact every single Canadian across the country. Just for simplicity's sake, let's say that a bank has $1 million in assets, right? These loans and things that they've given out, $1 million. And let's say OSFI has set the domestic stability buffer rate at 2%. So for that $1 million that the bank has, again, obviously an unrealistic number, but we're just using it for example, well, the bank has to keep on hand $20,000 or 2% of $1 million, right? But all you really need to understand going forward is that when this DSB goes up, that means banks have to keep more money on hand relative to their loans that they've given out. And if this number goes down, well, they don't have to keep as much money in hand in terms of actual cash that the bank has. And just this week, OSFI increased the DSB, right, the thing we've been talking about, to the highest number that it has ever been, 3%. Essentially, they're saying, hey, we're worried that there could be some sort of a stability risk to the Canadian economy, and we're telling you, the big banks, to save more money or hold on to more money as a backup in case people stop paying for their loans, the things that are considered the bank's assets. So you might be saying, okay, what does this really mean for me? I don't really care if the banks have to keep more money on hand. It doesn't impact me individually, but it actually does, because the way that the banks behave will be changed by the amount of cash they have to keep on hand. You see, if that DSB or domestic stability buffer is a lower percentage rate, well, the banks are incentivized to go out and lend more. They don't have to keep as much capital on hand in the event that there's a worst case scenario. If that DSB goes up, they have to keep more on hand, which means that they are less likely to lend to more people. The requirements to get a loan will be more stringent, and banks will be less incentivized to dramatically increase the amount of loans that they're giving out. And the most interesting thing is that you can actually use the DSB in watching how it changes over time as a way of reading OSFI's mind, saying, okay, what are they thinking about the risks that are in the Canadian economy, and where do they think things are going to go in the future? Before the pandemic, the DSB was sitting at 2.25%. Then when the pandemic happened, you'll remember that the big worry was that people weren't going to go into the economy. They weren't going to go spend money. People weren't going to lend to each other. So they made a bunch of changes, made it so that banks didn't have to keep as much money on hand for the amount of loans that they were putting out. Said, hey, big banks, you can have free reign. Go lend to everyone as much as you possibly can so that they'll spend in the economy and save us from this COVID recession. Then by June 2021, we already start to see the Bank of Canada raising interest rates again. There's so much demand inside of the economy. There's been so much lending going on. We want to sort of tamper that and bring that down a little bit. And OSFI has done the same thing, right? Saying, big banks, you have to keep more money on hand. Don't lend out as much money to people as quickly and as easily. Then by June 2022, well, the Bank of Canada had started raising interest rates. We saw inflation was getting way out of control. People were spending too much money. Maybe they were getting lent a little bit too much money, and that caused a lot of demand on a lot of spending. The Bank of Canada raised interest rates dramatically, and so too did OSFI in terms of raising the amount that big banks have to keep on hand, meaning, hey, they're telling the big banks, maybe stop lending out as easily. Also interesting to note is that June 2022, as of that date, the maximum that this DSB could be was 2.5%, but we'll get into how that's changed here in a minute. But what has made them act this way? What are they so afraid of that's prompted them to keep the rate at 1% all throughout the pandemic, then all of a sudden in June 2022 raise that up to 2.5%? What is it that they're afraid of, and why are they doing it? Well, the answer is in its name. This is the DSB, the Domestic Stability Buffer. They're worried about stability of the financial system in Canada. We're entering a very unique time where debts are extremely high in Canada. The Bank of Canada is jacking up interest rates far higher than they've been for the past number of years. And they're saying, hey, maybe there's a chance here that the Bank of Canada has gone too far, has raised rates too high relative to the amount of debt we have in Canada. And that could have some structural risks or some systemic risks risks for the Canadian financial system. So if they raise the amount of money that big banks have to have on hand to lend things out, they're kind of building up firepower in case the Bank of Canada's gone too far, we go into an awful recession, and then they can lower it back down to 1% and say, hey, banks, you can lend out just like you were before. We need some liquidity in this economy. We need people to start spending money again. So where are we today? Back in June of this year, we are already at the max of 2.5% for this DSB, but the Bank of Canada has continued to raise interest rates and the Canadian debt hasn't gone down at all. So what are we going to do? That leads us to this week's announcement that they'd be raising it higher than the previous maximum for the DSB to 3% and increasing the range that it can be from 0% to 4% as the range that they can now have the DSB can be any number in between there as opposed to 0 to 2.5 being the previous maximum. And remember, this 0% doesn't mean that banks, if it was at 0%, the DSB, that banks wouldn't have to have any money on hand at all. Remember, the DSB is just one portion of the capital reserve requirements that the banks actually have to adhere to. So OSFI is essentially saying, if I'm to translate these percentages in the changes to these numbers, OSFI is saying, well, big banks, we're worried that the people that you've lent to are more likely now than they were before to just not pay those loans. So we want you to keep more cash on hand to be able to pay for those debts in the event that people default on them. So what does this mean for individual Canadians and you directly? I think it breaks down into two major categories. The first one is housing, right? With banks having to have more cash on hand, that means that they can lend out less relative to the amount that they have on hand, meaning it could be harder for the next little while to get a mortgage or to qualify for a mortgage. That can make it more difficult to qualify for a mortgage through these large banks. And that also has an impact on the housing market itself, because if it's harder to get a mortgage, well, then there's less buyers in the market, meaning this could be another downward pressure on house prices. But the flip side is that this just doesn't apply only to mortgages. This applies to any loans that you could get through a traditional bank, right? And this could have a negative impact on Canadians that are struggling to make ends meet. So many Canadians right now are turning to either credit cards or lines of credit in order to cover their extra costs, because if their wage hasn't gone up and the cost of living's gone up, something's got to give, right? We've got people turning to credit cards. But the thing that I think is most negative here is that it means that less people will qualify at these banks for lower interest rate forms of debt, right? It's far better to cover your extra expenses on a line of credit than it is on a credit card, because typically lines of credit are at lower interest rates compared to credit cards, which are often at predatorily high interest rates, right? So people who may have been able to not finance their lifestyle on credit cards because they could qualify for and get and have the bank give them a line of credit, well, now they might not be able to get that line of credit and they might be forced onto these higher interest rate credit cards. Now, I think this is all kind of just a precautionary move by OSFI saying, hey, Bank of Canada, we think that you've kind of gotten to the max of your interest rate increases and you're kind of going to pause now and wait a little while, see if anything happens to the economy, see if we've actually got inflation down. But in the off chance that you've gone too far, we now have a little bit of dry powder in the future. Since our DSB rate is so high right now, we can lower that back down, add more liquidity to the market, more people spending, more people buying things, and that could counteract a recession alongside what the Bank of Canada likely would do if we hit a serious recession, where they would lower interest rates back down again, kind of like a repeat of what we did at the beginning of COVID, right? To trying to stimulate the economy. Obviously, there were parts of this video that were pretty dense, but I hope you learned something from it, and I'm curious what you think about all of it. Do you think that OSFI is making the right move here, making sure that banks are lending out less in this time, having more on hand, or do you think that maybe this move was preemptive and that they shouldn't be raising the maximum threshold for a DSB or the maximum rate it can be at? Either way, whatever you think about it, let me know down in the comments. I read every single one. I try to get back to a bunch of them, and make sure to subscribe to the channel if you haven't already done so. It helps out the channel dramatically and helps more Canadians see financial updates just like this one. And with all that said, thanks so much for watching, everybody. I really hope this video helped you out at least a little bit, and I'll see you next time.